If you own Infosys shares, the next 30 days could determine whether you make a nearly 20% premium on your stock or lose out on this opportunity. The company has announced its largest share buyback in history, a staggering 18,000 crore deal. They are offering to buy shares back at a premium price of rupees 1800, which is significantly higher than the current market price. This leaves you at a crossroads with three distinct options. Do you tender your shares for the buyback? Do you ignore the buyback and sell your shares on the open market? Or do you simply do nothing and hold your shares for the long haul? What's the right move? There is no one-size-fits-all answer. The best choice hinges on a few interconnected factors. This video is your clear step-by-step guide to understanding these factors and deciding which of the three parts is the most profitable for you. As an Infosys shareholder, you have three choices. It's critical to understand the pros and cons of each before you can make an informed decision. Let's break them down. Path A. Participate in the buyback. The appeal here is obvious, that premium price. Securing rupees 1800 for a share trading for less feels like a clear win. But there's a major catch, and it's the biggest drawback of this option: the acceptance ratio. Because the offer is so attractive, a huge number of shareholders will likely apply. Since the company is only buying back a limited number of shares, they can't accept every share from everyone. This means Infosys will probably accept only a small portion of the shares you offer. The rest will be returned to you, and you will have to decide what to do with them later. On top of that, as we'll discuss, a complicated new tax rule makes this path far less appealing than it once was. Path B. Sell on the open market. The primary advantage of this option is its simplicity and certainty. You can log into your trading account today, sell your entire Infosys holding at the current market price, and have your cash settled within days. There's no guesswork, no waiting, and no worrying about acceptance ratios. From a tax standpoint, it's also more straightforward. You'll pay a standard capital gains tax, which is a much cleaner and more predictable outcome for most investors. The downside, of course, is potential regret. You're giving up the chance to get that attractive rupees 1800 premium, and you might feel a sting if the stock price rallies after the buyback concludes. Path C. Hold your shares. This is the classic do-nothing option. You are consciously choosing to ignore the short-term noise of the buyback and the market's daily fluctuations. You're betting on your long-term investment in Infosys. If you believe in the long-term growth story of Infosys, its leadership, and its dominance in the IT sector, then holding your shares could prove to be the most rewarding strategy. This path requires patience and a belief that the buyback itself will unlock value for the remaining shareholders over time. A belief we will test against historical data. Step 2. The critical tax question. This next part is arguably the single most important factor in your decision. A tax rule that changed on October 1, 2024 has completely upended how share buybacks are taxed for the investor. Previously, the company paid a buyback tax, and the money you received was tax-free in your hands. It was simple. Now the tables have turned. The tax burden has shifted from the company directly onto you, the shareholder. Let's break down how this new rule works. When you tender your shares and the company accepts them, the entire amount you receive is now classified as income from other sources. Think of it like a dividend or interest from a fixed deposit. This amount is added to your total annual income and is taxed at your personal income tax slab rate. For anyone in the higher income brackets, this could translate to a punishing tax rate of 35% to 39%. But it gets even more complex. What about the original price you paid for your shares? The new rules stipulate that the purchase cost of your accepted shares is now treated as a capital loss. Here's the critical point. You are not allowed to use this capital loss to offset the income from other sources you just generated from the buyback. You can only set this loss against other capital gains, either this year or in the future. This mismatch, getting taxed heavily on the income while the corresponding loss is hard to use, makes the buyback option extremely inefficient from a tax standpoint. So, the very first question you must ask yourself is, what is my income tax slab? If you are in a high tax bracket, the 30% slab or above, the math works against you. The high tax on the gross proceeds will likely wipe out any benefit from the premium price, making participation a poor financial choice. If you fall into a lower or even zero tax bracket, the situation is different. The tax impact is minimal, and the buyback's premium price could still be a very attractive option. Step 3. The acceptance ratio reality check. Even if you're in a favorable tax bracket, your potential profit is capped by the acceptance ratio. Let's be realistic. Because the 1800 rupees offer price is so much higher than the market price, an overwhelming number of shareholders are expected to tender their shares. This flood of applications almost guarantees a low acceptance ratio, especially for retail investors. Based on similar past buybacks, analysts estimate this ratio could be anywhere from just 5% to 20%. Let's use a clear example. Imagine you're a retail investor with 111 Infosys shares and you tender all of them. Let's assume a hypothetical acceptance ratio of 8.38%. In this scenario, Infosys would accept only about 9 of your shares. For those 9 shares, you get the premium price of 1800 rupees each, but the other 102 shares are returned to your demat account. You are now stuck with those shares and must decide what to do with them at whatever the post-buyback market price is. That price could be higher, lower, or the same. The certainty is gone. You have to compare the small after-tax profit on those 9 accepted shares with the simpler, more certain profit from selling all 111 shares on the open market under the more favorable capital gains tax rules. For many, the complexity and uncertainty of the buyback for a small gain on a fraction of their holdings may not be worth it. Step 4. The long-term hold strategy. What if you ignore the noise and just hold on? This is Path C. History can offer some valuable clues here. This isn't Infosys' first rodeo. The company has conducted share buybacks in 2017, 2019, 2021, and 2022. Looking at the data from these past events reveals mixed but often positive results for long-term holders. For instance, after the 2017 and 2021 buybacks, the stock price initially dipped but then recovered and performed strongly. Following the 2017 buyback, the stock gained 9% in the subsequent 6 months. The performance after the 2021 buyback was even better, with the stock rallying 22% in the 6 months after the board's approval. On the other hand, the 2019 and 2022 buybacks delivered positive returns for shareholders in both the short and long term, showing a more immediate positive market reaction. This history suggests that while short-term weakness is possible, a buyback is fundamentally designed to benefit long-term investors. Here's why. A buyback reduces the total number of shares in circulation. When the company's total earnings are divided by a smaller number of shares, the earnings per share automatically increases. A higher EPS is a key metric that investors use to value a company, and it often leads to a higher stock price over the long run. By holding, you are betting that this mechanical improvement to the company's financials will eventually be rewarded by the market. Before we dive in, make sure you hit the like button and subscribe to Finance Story. Conclusion: your decision framework. So where does that leave you? As we said at the start, there is no single right answer, but you now have a logical framework to make the optimal choice for your financial situation. First, and most critically, check your income tax bracket. For most investors in high-income slabs, the new tax rules that took effect on October 1st, 2024, make participating in the buyback a financially unattractive option. For this group, the real choice is between selling on the market now or holding for long-term growth. Second, weigh the certainty of a market sale against the complexity of the buyback. If you are in a low or zero tax bracket, the buyback remains a viable option. Tendering your shares could net a small, tax-friendly profit on a fraction of your holdings. However, you must ask yourself if that small uncertain gain is worth the hassle compared to the simple, predictable outcome of selling all your shares at once on the open market. Finally, consider your investment horizon and your conviction in the company. For true long-term investors, especially those in higher tax brackets, history provides a compelling case to simply hold on. The data shows that allowing the buyback to enhance key metrics like EPS has often been a winning strategy over time. This decision boils down to your personal tax situation, your need for immediate cash, and your long-term vision for Infosys. So what's your game plan? Are you tendering, selling, or holding for the long run? Share your strategy and your reasoning in the comments below.